Welcome to another episode of Exploring Prosperity. Today, my guest is Ram Ahluwalia of Lumida Wealth Management. Ram's a high-energy markets guy. He keeps his eye on domestic and foreign markets and economies and searches for counter-consensus ideas that can actually pay off over the longer run. I think you'll enjoy what he says about the markets for the next few months and quarters and ideas that we both came away with from a conference that we attended together and some of the other things that went on this week. I hope you enjoy the episode. Great, Ram. It's great to see you again. Thanks for joining.
Thanks, Bob. Great to see you too.
Well, we had a big week this week. You did a great piece about OpenAI that I definitely want to highlight. And then we attended a conference together in Dubai, which was very interesting. There were we could talk about some of the takeaways there. And then you had a great podcast on one of the big topics, which is quantum and Bitcoin, among other things. And I also attended another conference. What's also interesting is I wrote an essay yesterday, and it had it had echoes of what you wrote today about perception and narratives and investing.
This will be fun.
But anyway, so let's dive right into OpenAI because it was a big event this week. It sent the markets lower. Sam Altman brings down the world, I think is what you said.
So let's get into why Sam Altman broke the world. That's the topic of the day.
That is.
Some of this has reminiscences of 2008. You and I both lived through that. And the core issue is that you've got $1 trillion in debt that's been socialized across the ecosystem. The nature of that debt consists of OpenAI revenue performance obligations. What we learned today from the interview with Dario is that similarly, they also have hundreds of billions of dollars of so-called revenue performance obligations across the ecosystem. And
what that really means, Ram, is that they're on the hook to make payments to data centers, presumably, almost primarily, right, for compute power. And that is dependent on their generating revenue in order to pay it.
Exactly. They have to pay for it either through revenue or from raising capital. Now, let's do some math. OpenAI CEO Sam Altman said that they've got $1 trillion in such quote-unquote committed obligations. Now, committed obligations is the same word as debt. You have to honor your contract on pain of default. And they close the year with $23 billion in revenue. Not free cash flow, revenue. That's just top line. They got to pay for salaries, which is a significant driver of their cost also. So even if you're incredibly generous to their forecast, suppose you say they triple their revenue, suppose you say Anthropic does it also, there's not enough to meet their obligations. Now, these obligations are through the end of the decade, but you have to believe that these companies get to hyperscaler status, like $1 trillion in revenue by the end of the decade. It's not mathematically possible for more than one to do it. And you have these other issues, which that you have a freemium model. Google's charging $0, Meta's charging $0. They're freemium companies that make money in advertising.
Yeah, Grok is essentially $0 if you pay X.
Yes. There's no way the math can foot, so they have to raise capital. That's the only way to do it. And how do you raise capital? Well, you tell the investors you're going to be $1 trillion revenue company. It's a spreadsheet. They're raising money off of spreadsheets. What we're already seeing now is that Gemini is growing at a much faster rate than even OpenAI. Google's Gemini is growing at a faster rate than OpenAI. You're not supposed to see that at this stage. So you've got a lot of fixed costs, and you've got a data center spend pipeline that can't be funded. So they will go public this year because they have no choice. And then after that, where's the capital going to come from? There's no way the math can foot. So what it means is you've got $860 billion in equity valuation. That's not actually worth that, just on OpenAI. You got $1 trillion in committed obligations from OpenAI. That's also not worth that. So if you're Oracle or Microsoft, you've got each of them has over $100 billion in counterparty exposure to OpenAI. They need OpenAI to raise the money so that their contract billings, the assets for them are called RPO, so they don't get a write-down. And if you get a write-down, it impairs your equity. This is why when Microsoft reported, And they said they got over $400 billion in revenue performance obligations, 48% of which is linked to OpenAI. The stock dropped 10%. And this is also why Oracle raised $25 billion, not only in debt, but also equity capital. This is what we saw in the 2008 crisis, by the way. I'm not saying this is the 2008 crisis. I am saying that you've got bad balance sheets in tech companies.
Or echoes of it. Yeah.
Yes.
Yeah, it's funny because, as you pointed out, it's not a balance sheet item. In the old days, it was. So you could see it, and but not this time. And this was the week where you could see it. It was revealed through that Microsoft earnings report. Let's play it out a little bit, because if it does seem, let's take that on face value, that the revenues can't possibly be raised by any single AI, even if there was only one, but we have multiple. And so the revenues will fall short. What winds up happening? Do these companies, as OpenAI, become absorbed by the data center companies, the hyperscalers?
This show is being brought to you by our sponsor, Truflation. Professional investors and economists, and probably any casual observers, know that government inflation statistics are only an approximation of what real inflation is. Not only that, but the government has a conflict of interest because high inflation can be so damaging to the economy, the deficit, and our $36 trillion in debt. Truflation collects over 80 million pricing data points. Most are updated daily to reveal inflation with precision for asset managers, governments, companies, and the general public. Check them out at truflation.com.
Yeah, the debtors are first in line to get paid, and customers often have a first priority claim. It depends on what that capital structure looks like and have they taken out debt. And this is another reason why you've seen the private credit complex under pressure. So that, the Blackstones and the Apollos of the world and CLOs, they're trading lower too, because they're playing a role in financing the data center. But yeah, look, if OpenAI goes public and Anthropic goes public, the stock starts selling off immediately. I mean, I'm being offered access to buy OpenAI stock at a bargain of 20% discount to this 860 billion valuation. What kind of nonsense is that? What's the real price? What's the real price? Who's the seller on the other side?
Ram, before you write that check, I would have a conversation with yourself.
I know, exactly. I'll be the first to pass on that. Here's another fun fact. I had a lunch with two SPAC bankers in New York. They're doing frontier stuff, highly thematic concepts. And they said, yeah, our buddy had a banner year last year. I said, what did he do? He said, well, he was organizing OpenAI SPVs. He was brokering, like tens and tens of millions of purchases and sales. Who do you think is selling? Who do you think is selling? It's people close to the company. It's early players, insiders, as it always is. Who's buying?
Because there's no other stock, right?
Yes, exactly. The insider.
All the big players are essentially locked up. I wonder if there's a secondary market for the institutional investors.
They'll find a way.
Well, yeah, now they will.
They're finding a way to de-risk. They don't want to sit through a 6-month lockup when you just saw these IPOs go public over the past year, and the vast majority of them are below their IPO price. Take Figma, for example, it's down 80%, and plenty of others are also. So capital markets can't digest those IPOs, and they can't digest SpaceX going public either, which is also a fantasy. $1 trillion, you're seeing you expect multi-trillion dollar companies to go public all in the same year. The funding's just not there. So said another way, the AI capital markets, there's a dependency between AI and capital markets. AI has a capital markets dependency. This has nothing to do with whether or not AI is transformational. Yes, it is. Of course it is. It's going to drive productivity growth. We're all going to live better lives. We can't wait for AI to come fast enough. This is a key point. A lot of people listen to this and say, well, no, I think AI is real and it's going to transform. I agree with you, yes. This is purely about the dependency that AI CapEx has on capital markets. And that capital markets dependency is weakening. We see that in the share price of Microsoft. We see that in Oracle. You see that in higher funding costs for these data center companies also. You see that in who the marginal investor is. SoftBank, Middle East sovereign wealth funds. It's as far from Silicon Valley as you can get. It's not smart money.
We're proud to be sponsored by Foundation. They've created Passport, one of the top-rated Bitcoin hardware wallets, proudly made in the USA. It's fully open source and air-gapped, meaning your Bitcoin stays completely offline and secure. The shocking Bybit exchange hack shows why holding some Bitcoin offline diversifies risk. Now they're launching Passport Prime, your all-in-one solution for not only Bitcoin, but all passwords and 2FA security. Head to foundation.xyz to secure your digital future. So if it just seems like the acceleration of compute power is dependent on all of this, and therefore the amount of compute power may not be necessary or will not be achieved. Does that slow down the development of AI then? Or does it fall into the hands of other people?
It's a great question. I think the GPUs NVIDIA builds will ultimately get bought anyway. It's a different mix of buyers. If there's a default on a data center contract, it gets assigned to someone else. Like the demand for AI is still strong across corporates. You're seeing defense start to focus on this also. So what you want to avoid here is like the commodity bullwhip. And we're both familiar with the commodity bullwhip cycle. The LLMs are at the tip of the commodity bullwhip. They're facing that subtle shift in marginal demand. You want to be as upstream as possible, like Taiwan Semiconductor, for example. So they're less exposed to these round trip considerations. And so I think the GPUs still get placed. Data centers are going through rapid transformation. You're going from the CPU model to the GPU model. We're still early in that transformation, and the hyperscalers will fund the CapEx, so they'll move in that direction.
Yeah, that's the difference between this and the telecom cycle of the internet age, in that these are gigantic companies that have using the cash on the balance sheet rather than depending on capital flows from investors and lenders.
That's correct. Now, the dot-com cycle is an interesting one to point out because there was a lot of CapEx investment in that cycle too. And it was funded by venture capital money. Now you do see that here too, ex-hyperscaler. So away from the hyperscalers with OpenAI, you see that. So that funding source will dry up. So you'll have to see a shift in the consumption of GPUs towards better financed players.
What are the investment implications for the next quarter or two?
Unfortunately, it's not the prettiest thing in the world. I'm sorry to break the news, but you're seeing this play out on markets now. You've seen United States stock market kind of lag global markets. That's in large part due to the underperformance of the technology sector.
And by magnitude, I mean, it really is enormous. If you look at the averages, S&P 500, for instance, it's only off maybe, is it 5% now? I don't even think it's that much.
Yeah, S&P is still in their all-time highs, actually. And Dow Jones is at all-time highs.
Exactly. And it's sector by sector. And so there's a broadening out of the performance. But
yes,
I
think that'll happen. That'll continue to happen. Exactly right. So the tech sector is ground zero for all of this. And you've got names like Microsoft and Amazon and Meta below the 200-day moving average. Google just went below a shorter term moving average now. So there's a rotation from these crowded themes. AI and these Mag 7 stocks were highly crowded. I think they will lag and underperform. And you're going to see a shift towards everyone else, especially ignored, unloved names in the last 3 years that didn't participate in the rally. And that's what's working the best. Look at Dollar General. It's doing fantastic. Quite a few names that have been ignored. Look at oilfield services, doing great. Consumer staples, doing pretty well. Inflation-resistant names as a category, if you want like a summary theme, you're seeing that too. Commodities, staples, energy, and energy-related. What does all that have in common? Inflation. So, by the way, when you see that theme work, it's not great for risk assets. You saw that theme.
It's the opposite, yeah.
It's the opposite.
Yeah.
You're really going to be on your guard. And set against that backdrop, you've got a Fed that's asked to cut rates, going to lower rates in a run at hot economy. So markets are saying, hey, inflation's coming. No, we don't see the CPI now, obviously. CPI.
No, and we don't see it in trueflation either.
Correct. So we don't see it in the current data, but markets are looking forward.
They do. This seems to be a little bit of more of an anomaly than in the past. In my experience, the inflation is bottoming rather than declining when you start seeing inflation equities, inflation sensitive equities starting to respond favorably. But
we'll see. Yeah.
It does feel like we could be heading that way with Warsh coming in and lower rates when you feel the economy starting to move faster. That's going to definitely be the knee-jerk reaction to markets.
Yes. Markets oscillate between fear of growth slowdown or fear of inflation. It really doesn't have the middle speed. So it's either we're running too hot or we're having a slowdown. And right now, markets are starting to discount a higher inflation trajectory. Now, of course, AI is deflationary. Go ahead. Yeah.
Mm-hmm. Does so are those sectors should continue to be okay if in this AI decline?
I believe so. That you're talking about. Yeah, we are really significantly overweight. We're overweight energy, oil field services.
Yeah, I mean, the overall S&P actually may be able to hold in and continue to rise.
I think the S&P finishes higher. Yeah, I think S&P finishes higher this year, correct, at year end. There's correction risk, I would say, in the first half of the year, though. That can happen.
Because we haven't had a real correction for a while.
Correct. Now, in tech, you've had a correction. We're maybe some halfway through this, perhaps more also. That's a good sign. And, the VIX is at 22, so lots getting priced in here. But I would expect that tech continues to lag, right? QQQ is the worst category year to date as compared to the Dow Jones, which is the best. So we've gone from zeros and ones to the physical, the Dow, industrials, value, free cash flow, dinosaur.
And energy.
Yes. I would expect that continues. I would expect that certainly continues.
Yeah, I think so. I think the energy. I think that we're going to the overall global economy should be chugging along just fine, and energy should be responding, especially because you do get this AI. There's still going to be an AI build out, and there's still going to be a growing amount of electricity needs in the near term.
Materials are doing well also. So there's plenty out there that's doing well, but you hit the nail on the head. It really is about broadening. It's these sectors that haven't done well in the United States in the past are doing great now. Look at small caps. Small caps are outrunning these categories, and also international names are outrunning the United States.
Well, there's an interesting on the software stocks. I attended a conference this week where Cathie Wood and Dan Ives were saying this is one of the best opportunities to invest in software stocks in history, and Cathie Wood likened it to COVID decline, and Dan Ives just said, the future is technology driven, and it's going to be a much better world, and all these companies are going to be leading it. And we have the other side of that from the All In podcast with Brad Gerstner and team last week, talking about how software is highly vulnerable, and then the more alarmist Jordi Visser, who's out saying that software is really, it may be embedded in the large companies, but no one's going to need it in the small companies, and AI can really replace it pretty rapidly. It sounds like you're a little bit more on the side of let's not bet too heavily on the software names for a while.
I think there's a bit of truth in each of those. Let's go through that. So I was in the bear camp on software like 2 years ago, and I saw Midjourney come out, and I said, you don't want to own Adobe, and you don't want to own Salesforce, because why can't you dream up a dashboard and have an AI spin it up on the fly, and now you're productive again? So I believe that view is priced in at this point. And over the last few weeks, I've bought HubSpot and I've bought Salesforce and even Adobe, but many names are still quite expensive, and there's still a lot of share-based compensation out there. MongoDB is very pricey. It's not a COVID bargain. That's just not the case. COVID, you back up the truck and you go because the value screams off the page. Remember like when oil was at $0 a barrel?
Negative, wasn't it?
Yes. Yeah, you could throw a dart and buy something and you did extremely well. These are not COVID bargains. That's just not true. Figma is down 80% from its IPO. Its forward PE is 100 times. 100 times. So you have to be very selective here, and we could still be early. It's great when you see the entire theme cheap and on sale, like you saw in the so-called banking crisis of March in 2023, when all the banks were cheap and it was too much fear. You're starting to see some of that now in payments, although it's a very crowded and tense competition, but those are cheap. Like you can see the free cash yields are just very high across the board. We don't yet see that in software, just to be clear. So at best, it's a mixed story. Now, will AI totally disrupt software, make it go away? No. AI has to comply with HIPAA regulations, personally identifiable information. Good luck spinning that up. A lot of these software businesses have real moats and switching costs.
That's right. I mean,
yeah,
especially for large corporations.
Yes.
The reality is that what you talked about, you can put together a company using agents and run a large company by yourself these days. You can do that. But the large companies, the changes like this don't happen overnight. There are people that can adapt these agents quickly and run extraordinary capabilities with very little input, and they do not need software companies. But the world so far has an embedded software demand that isn't likely to go away. But the growth is probably what Brad Gerstner was talking about. You're watching the growth part of it.
Yeah, I agree. Enterprise requires more sophistication and tooling. That's an installed base. Switching costs are high. The enterprise is going to focus on how do they create more value for the customer. Even small businesses, I'm not even sure that just because they can vibe code a solution that they will. We have 24 employees here. We have 9 of which are engineers, and we're not doing that. In fact, we just signed up with HubSpot 3 weeks ago because our marginal use of an engineer's time is on creating value for the customer. It's not on cost mitigation. It's always about value maximization. You're willing to pay for value. If HubSpot costs me $25,000 a year, that's cheaper than the use of the engineer's time. I'd rather have the engineer focused on creating something valuable. I don't need the management oversight either. Is my time best used in managing some vibe-coded CRM? No, that's not the case either.
Well, there were 2 people that pointed out that the Bitcoin chart has followed software very closely over the last year or 2.
So no, I agree. I think there is some correlation there. I know there is, but I think there is some causation between software and Bitcoin. I call it the West Coast Tech Bro portfolio, aka Chamath portfolio. I'm just kind of having fun with this a bit, but people tend to own similar assets in concert. So they're owning Bitcoin, they're owning software stocks, they're owning Tesla, Palantir, and they're rising and falling together, not perfectly. Software and Bitcoin is more like a 2016 to 2020 West Coast kind of thesis. When you see pressure on one part of your portfolio, if you have levered exposure, you've got to sell and you've got to de-risk and you got to sell whatever you can. And that's the kind of dynamic I think that's happening here. So I believe that there is a shareholding base that owns both of these assets. Right. So Satoshi conference is a fascinating conference. A lot of thoughtful investors, venture funds, crypto natives. Yeah, a lot of discussion around AI, also Bitcoin, of course, and longevity.
There was probably the most interesting meeting I went to was what would Satoshi think, and I thought it was very interesting to hear a lot of the people that have been invested for a while talking about how institutional ownership dilutes what Bitcoin's intention originally was. and the lack of peer-to-peer payments and payment capability also kind of takes away from Bitcoin some of the real importance of it and direction of it from the early days. And I noticed that these are perceptions about Bitcoin more than the Bitcoin itself, which doesn't change.
I agree. I think Satoshi would be disappointed. He'd be disappointed for a number of reasons. One is the original paper is called Electronic Peer-to-Peer Cash. One. Two, now we have the rise of stable coins, and stable coins are playing that role. The other is crypto has essentially become the next generation of fintech. What can you do with the blockchain? You can move value trustlessly. You can borrow, lend on chain. You can tokenize real world assets. You have a ledger. These are the functions that banks and clearinghouses perform. So when I say that it's become FinTech 3.0, it also mean that it's fallen under the classic regulatory framework as well. So that is really antithetical to the crypto anarcho-capitalist William Gibson neuromancer cyberpunk vision of crypto, which Satoshi was a part of. Being fully anonymous, for example, would be incompatible with a KYC AML regime. I think that's a pretty clear and obvious statement one can make. And then the fact that Bitcoin is now identified with like America First and is national, I think he would be disappointed in that too. So I don't think I think he'd be incredibly pleased with how far Bitcoin's come. Of course,
Well,
right? Like in that sense, he's like, wow, this is amazing. This thing worked, right? Why did I
hundreds of millions of people.
Bitcoin, right?
Yeah,
In that
hundreds
sense,
of millions of people.
in some macro sense, yeah, he'd be overjoyed. From another sense, it's been co-opted by the financial system. Like BlackRock is now letting you access Bitcoin via an ETF, as opposed to a permissionless
TradFi wrapper.
Yeah, exactly. So he'd say, "What have you done? You turned it into a Big Mac and sold it via, a decades-old, retailer."
I do imagine, though, that he would have thought that at some point that is what would happen to it. That it would have, once it got big enough, it would have to start fitting into the existing structure. And I'm not sure the fact that it is fitting into the existing structure undermines its long-term potential.
Oh, I don't think it undermines long-term potential.
Exactly.
No, I don't think it undermines long-term potential. In fact, it's part of adoption. It's part of what adoption looks like. So
100%.
I agree. I still think the cyberpunk ethos, though, that where he came from and that initial vision and values is very different from what you see right now.
Absolutely. And, look, the reality is this is a new invention, and the people that first created it and understood it have necessarily a different outlook on it than subsequent generations of adopters, especially if you think in terms of real generations, 30, 40, 50, 60, 80 years. I heard one person arguing that this is a 3-generation adoption curve. Get used to it. I think there's a
lot to be said for that. Yeah, it goes back to the concept of like the fourth turning, and it takes generations to adopt, and the next generation is more open to the concept of digital assets, the idea that you can have value that's in a digital form, as opposed to a gold bar somewhere.
Yes.
But that takes time. That takes time for that transition to take place, because that generation needs to grow up in industry, and that's a process.
Indeed. Well, one of the other things that I thought was very interesting is how many tokenization sessions there were.
So yeah, tokenization is it's an opportunity set I've been talking about for a few years also, and it's another promise of, can you put value on chain? There's been a lot of focus around tokenization. It does have a lot of promise potential too. That said, it's also been co-opted by the legacy players, the DTCC, BlackRock, JP Morgan's tokenized, different money market funds. So, and they've got distribution, they've got customers, they've got compliance. They're moving on all this stuff. And it seems like they're well positioned to capture a lot of the economics from this too. So I feel like the crypto crowd has failed to focus on the underserved opportunities around tokenization. That doesn't mean tokenizing public equities and securities so you get 24/7 trading. That's a crowded competitive market with legacy infrastructure that can adapt. But there are other areas that can be tokenized that crypto's not focused on. They're trying to focus on head-on competition.
It feels to me like it ran into a brick wall on the regulatory front, and that yes, it's been adopted and maybe co-opted by traditional financial firms, this idea of tokenization, but that too seems to me to have been inevitable. That there was plenty. I knew a number of companies that were working on tokenization. It's hard to find customers.
I think there's a strategic distraction. Crypto firms made a wrong move and they decided to take on Wall Street. And there's a lot of hubris and ego and all of that. They decided to go after the most liquid, competitive securities market in the world because they thought they had a better mousetrap. And they didn't realize there are decades and decades of infrastructure and systems built around this. It's not just the Bloomberg terminal, it's the fixed protocol, it's the settlements, reconciliation, it's order matching engines. There's so much that's been built.
Not to mention the embedded daily human routines.
The daily workflows, the human routines. It was really an act of ego and hubris and not understanding the system and just being overly cocky around the opportunity to just tokenize equities and assuming it would work. Like, the equities market's extremely efficient. We're talking about mills in terms of pricing. You got market makers that create liquidity and efficient execution. And they thought that just, okay, if I tokenize, that's going to solve everything and distribution is going to come along with that. And these firms don't know how to do that. It was a lot of ego. What they didn't do is focus on the underserved parts of the market, such as small businesses. There are plenty of companies there that can't access public capital markets, and public capital markets have a lot of compliance costs and legal costs and registration costs, and there's a big marketing process around it. And the SEC chair has been talking about how there are far fewer public companies today than there were a few decades ago, and that deprives the investing public of opportunities. Crypto hasn't focused on that. It's kind of funny they haven't, because they did that whole ICO craze in 2017, which in a way was was venture capital for on-chain. But that won't work either, because you have misaligned incentives, you don't have vesting schedules, you don't have alignment of interests. You had a lot of pump and dumps and people taking advantage of retail investors. So what's really been missed is focusing on small business and Main Street. And you've got the primary job creator in the United States remains and always has been small business. And banks lend to them. Banks do underwriting for these small businesses, which means they're good from a lending perspective. And if they're good from a lending perspective, they're probably good from an equity perspective. They've done the underwriting. That category hasn't been served.
It's Blackstone, a really important point. Yeah.
Right. Blackstone bought Mike's Jersey's Pizza, right, for a couple $2 billion, a Subway chain, right? Jersey Mike Subs. Blackstone bought Jersey Mike Subs for a couple $2 billion. Chick-fil-A is a multi-billion-dollar private company. So is Trader Joe's. There are other real businesses out there that can't get financing. They can't get equity capital. You would think that this tokenization market would have focused on that underserved segment. Started with Arthur Levin, my friend and mentor. He's a Lumina investor too. He was writing an op-ed stories in Wall Street Journal about this. And let's talk about that now. It's like, what, is more of the value creation happening in private markets? Yes and no. On the one hand, you're seeing valuations for a company like Stripe go to $130 billion in private markets. This is kind of fantastical stuff. The idea you could have a $130 billion private company is that's venture backed is just, it's a modern phenomena. It's a last 5 years phenomena. It's not a healthy thing. I think it's it's just a bubble in venture capital. That's really what's happening here. And you've got 540 crypto VCs that are out there, for example, little case study one. And you've got maybe 10 protocols that matter, and maybe 10 to 15 businesses that matter, which we all know. We can name them, maybe even less than that. That doesn't make any sense.
And you look at a self-correcting mechanism, I would expect.
You're seeing the self-correction happen now in crypto asset prices, and DATs all in bear markets now. Circle's stock tanked after the unlock. Tether is walking down the valuation. And look at what happened when Brex was acquired. Brex was bought by Capital One in a take under valuation of $5 billion. They raised in 2021 at like $12 billion. And you get 20% inflation between now and then. That's not a good outcome. So every payments company that's publicly traded is in a significant bear market. Adyen is down 20% Friday of last week, and it's down 60% since 2021. And yet Stripe went from 86 billion valuation to 130 billion valuation. That's just a made up number. I think these companies are overpriced, and the VCs need those companies to maintain high private market valuations so they can raise money for the next fund. It is really unethical. The LPs in this stuff, Harvard universities, endowments, there's some LP there. Why are they doing it? Well, one, they get to show a mark that's going up, even though it's not a real mark, and they're going to pay the consequence in 10 years when it's someone else in their seat. It's not their money. It's other people's money. You know what Milton Friedman said? The worst quadrant to be in is when another person is spending another person's money. There's no accountability. There's no alignment. That's what's happening. And there's also a big social aspect to this. Show me a top VC that doesn't have an annual conference where the LPs get to meet the founders and they're part of this big social club. That's what it is too. And they get to feel informed. They're actually consuming quote unquote insight or innovation content and experience by paying egregious fees for these massively overpriced companies. They just listen to a podcast. A lot cheaper. You get the same takeaways.
and you can listen to all of them too. I guess you just can't meet them and shake their hand on a podcast.
That's all it is. That's all it is. It's folly. It's the folly of human nature.
Well, while we were in Dubai, there were a number of sessions on quantum computing and the risk to Bitcoin and crypto. And this week you happen to have co-hosted a podcast with Nick Carter, who has done a terrific job of scaring everybody about it. It may be providing a wonderful service to the world, and it may not be. I am curious what you learned from Nick the other day. I mean, he really, for our audience, he wrote a few different essays that were enormously well researched, and he came away from these feeling that Bitcoin developers need to start the process of developing a protection against quantum computing, which threatens to expose private keys of a large number of addresses, particularly old ones that haven't had any keys moved. And so that's the threat. It's not a threat to the Bitcoin network itself. There isn't a narrative about that. But let's talk about that for a second. What did you learn on the podcast, and what did you learn at the conference?
Right. So his conclusion is that quantum is a real threat to Bitcoin. It's not a distant theoretical thought experiment. Second, people are listening. Look at what Michael Saylor said this past week. He's going to have some heightened focus around quantum and build a group of thought leaders.
More because he had to address this issue than because it was an idea that he thought was urgent or necessary today.
Right. So he's capitulated. And third, look, if you have an expected value on this left tail scenario where quantum cracks the private keys, And the value of Bitcoin is very low in that. That needs to be discounted into markets. So that's
I believe
not.
it has been. In the conference I attended this week, it was somebody who's very involved in the institutional market said a year ago they received 5% inquiries about quantum, and none of them considered it a tail risk. That was 30% a few months ago, and this person suspected that it might be 50% or higher today, and I would guess it is higher today. And that in an institutional framework, you're going to run a bear case scenario, and that bear case scenario of 0 or near 0 now has a legitimate allocation of probability where it didn't a year ago.
Right. What institution wants to look stupid for buying Bitcoin ahead of a quantum, event? It's a significant issue.
It is. I've been thinking that all along, and most people were not. And before Nick wrote about it, Bitcoin was off, and I was hearing more and more about it. And so, what's your takeaway on this?
I think crypto's in a bear market, Bitcoin's in a bear market, along with other animal spirit names and other high beta names. And you need to see where we are, maybe around the fall. Maybe it'll take time for things to settle. Once we identify the problem, people can start to focus and address it. I think they will. So we'll see where we are. We'll revisit it. It's a very gnarly issue. It's an extremely complex issue. Now, suppose you have a new framework, a quantum-resistant Bitcoin. You need some transition process for everyone. Suppose Satoshi doesn't do the required set of steps to transition from the old to the new, whatever that might be. Then his private keys under the legacy framework would be at risk. You could see Satoshi's Bitcoin be compromised just because he hasn't done the migration. There's a lot of issues like that.
That's the risk right there. Yep.
Well, there's a lot of issues that we're just scratching the surface around.
Yeah.
Even if you get a solution.
One person at the conference in Dubai offered up a white paper that shows how quantum resistance does not require a hard fork in the Bitcoin network. That is what Nick Carter believes is necessary. And part of the reason he's raising the alarm is he wants the developer community to start on this so that we can come up with a consensus that is very difficult to achieve and hasn't yet been achieved for Bitcoin.
I'm not the technical expert, but I would believe that hard fork would be required. This is a pretty substantial type of change here. There's a lot to process. Yep. There's a lot of risk.
One of the interesting things is we all assume that if quantum capability could derive a private key from a public key, that it would, and that is an assumption that I think is faulty. In fact, I would guess that would be very unlikely, even if quantum could. And it's just the simple game theory that if you want to use a quantum computer to break in and use it illegally to take something, the last thing you would want to touch is a blockchain protocol, because the value of that protocol would decline precipitously. So you steal $100 and it's worth $20 as soon as you walk out with it. You go to a bank account, you steal $100, the $100 is worth $100. So, and that's the illegal use of quantum. But if you and I had a quantum computer, we would look at those two universes as infinitesimally small compared to the virtually infinite profits that we should be able to generate by applying our new technology in a legal way, by either creating new companies or, even easier, by just leasing that capability out to large industries or governments. And so the amount, the size of those opportunities are just so massively divergent that I don't believe that a rational player would ever get around to messing with crypto protocol until way after we'd be able to protect it.
Well, what if there was more than one player that lands on this technology at the same time? What's the game theory say there? The game theory says that strike first.
But you wouldn't gain anything by striking Bitcoin. You would strike a bank. If you want to use it illegally, there are so many better places to go than trying to
right.
crack
The other,
Ethereum
the other threat vectors and all the rest, like they would target banks, they would target those would also be more hardened targets too. Right. It's not simply going to be crack encryption. There'll be other modes of cybersecurity that are layered on to access, say, bank reserves or the Fedwire system.
Which is really another reason that the idea of using it to break the law and take something is less likely. And I don't particularly care whether you're a bad person or a good person. If you have the quantum, you're still going to be looking at these economic opportunities as enormously different. And so what's to say that, guess what, we're gonna, or any bad actor, we use that.
Yeah, I mean, like they're criminal opportunists, and they'll go after whatever opportunity they see in front of them, where they believe they got specialized expertise.
Perhaps, but it's hard to see a criminal that has ever had the potential that this would reveal. But none of this actually, this theoretical is interesting, but we still need to protect Bitcoin for Bitcoin to be able to perform.
Yes. Right.
So,
right.
And ironically, I would give it a higher chance that somebody who developed quantum, because you've got the capability to do this, so you're generally going to be a large organization of some sort. It would be probably smarter to buy a little Bitcoin and protect the Bitcoin with your quantum than it would be to attack it.
Well, yeah, it's probably like a Google or IBM. They seem to be in the pole position right now around quantum. I don't think I see quantum stocks.
In the free world, yeah, for the non-governmental.
Free world. In the free world, correct.
Yep.
And they'll license and permission, right? Who has access to that? But yeah.
One session, I listened to someone who seemed to be extremely knowledgeable about quantum, and he pointed out that the qubits are the measurement of the power of the quantum, and that you will pass by all communications networks and all financial networks at somewhere between 50 and 60 qubits. And that to get to SHA-256, which is the code for Bitcoin, to derive a private key from a public key, would be in the thousands of qubits. And there's a lot of debate about how many thousands, and so that too would suggest that you'll have a long time to be able to protect the SHA-256 way after other opportunity sets have presented themselves to criminals.
Yeah, no, that makes a lot of sense too. I agree. We got a long way to go to get to that level of technology. The world will be a far better place when we're at that level of technology.
I think so. What other things did you take away from the conference out in Dubai?
I'd say, people are focused on these exciting themes like AI and robotics and quantum, and people have forgotten these real world needs where we started the conversation with. I was at one panel. They said like, hey, what's your top non-consensus idea? I said, senior living care for the elderly. And it was such an alien concept to the audience. One guy pulled me aside and said, let's get dinner tonight. That was the first original thing he had heard. I was like, great, find someone like-minded. But I do think people are kind of punch drunk with the techno-optimist future. Look, I'm a techno-optimist myself. I do a live stream podcast in a self-driving car where I'm looking at my phone. Okay, so I see it coming too. But I think people have lost sight of solving real world problems, care for the elderly, care for the young, healthcare, job training, education, especially education, retraining, public education, high school education. They need to disrupt college. These are the things where we need capital, talent, entrepreneurship. How many AI agentic tokens did crypto create, or decentralized physical infrastructure? These are just jargony buzzwords that don't create value. So I personally have like a big distaste for crypto venture capital and what we've seen over the last year. I think many of them should be ashamed for not building real businesses. And Nick talked about this on the podcast. So like, It's like, look, I'm one of the few people that invest in real businesses. Things that have free cash flow, things that generate earnings, things that solve real problems. And that's what investing is actually about. So I had my first sit down at a lunch with an individual who worth at least $100 million in Bitcoin. And I think after our initial greetings, I think minute number 5, I said, look, I think Bitcoin is meant to be traded, not hodled. I think you want to make sure you're on the right side of the trend, but it's not meant to be hodled, which created a severe allergic reaction and like offense. It was like a violent offense I'd committed. And I was like, you don't know what Bitcoin is. Let me send you these 3 Michael Saylor videos, which he then sent me 3 Michael Saylor videos. It's funny because we sat down, I think Bitcoin was 75,000. The next day was 72,000. When we left the conference, it was 65,000. It's kind of a funny backdrop to all of this.
Ram, what I noticed there was that while it was declining so rapidly, it never came up as a subject. People they weren't talking about it.
That's exactly where I was going next. So I think, there's this concept of like the frog boiling in the water. It's just fine here meme. We've seen that meme, the guy in the burning house. I'm not convinced the bear market has concluded. That doesn't mean you don't get a violent bear market rally, but I don't see despondency and fear. I see disappointment. And people are still very like tribal about their position. And I see that in other markets too. I see it for people holding Palantir stock, which is in a major drawdown and bear market. I see it for people holding Robinhood stock or SoFi stock and all these high beta names that were just really online Twitter community pumps. All of them led by a tribal leader. It used to be, you have the modern prophets now, right? The prophet of Michael Saylor, the prophet of Palantir. This is KOL from all those. There's like Tom Lee, there's Kathy Wood. And my view is that all of these KOLs will lose significant reputation this year, that their followers will get hurt. They will jump off the cliff like lemmings, buying the dip that keeps dipping. It's the general pattern I'm seeing play out right now. Show me a KOL that's not on the right side. They're all defending, right? Tom Lee, Ethereum will be at 10K by year end. Sorry, January. No, Bitcoin 250. No, I'm kidding. End of Q1. Oh, the bear market's going to end now, right? This is the nature of markets. It's kind of, so that the tribalism and it's just fine here. Remember, there's a debate we saw online between a fast growing KOL. His name is Amit. His headline was like, Amit is investing, debating Michael Burry. Kind of amazing time where retail investor can talk to like Michael Burry online.
100%. Yeah.
They had this debate and,
was that about Bitcoin?
It was around Palantir. Defending Palantir stock, despite the, valuations and kind of questions that came up. But the general point I'm making is that these KOLs are on defense and hanging on to their ideology. They have a thought bubble wrapped around them. They're not accepting critical dissent, like what Nick Carter's pointing out. And if you hang on to ideology, the markets will make you pay for that ideology. I believe that's what we're seeing now. I think people have to unglue themselves from the themes they fell in love with in the last 2 to 3 years, including AI and biotech and drones and space and robotics, whatever Kathy Wood is buying. And you have to really do the exact opposite and find ideas and names and themes that are real world atoms, etc.
Yeah, no, it's important to keep an awareness about a breadth of information and different trends, but the markets are very good at making the largest number of people look.
Yeah. I had this post I wrote yesterday around why most money managers lag the S&P. And I'll summarize it briefly for you, but the first part of any great rally is the non-consensus hated rally, which we saw in Bitcoin in 2023, or buying the banks in 2023, when both were left for dead in the wake of SBF collapsing and FTX collapsing and these banking issues. It was a great time to buy banks. Then phase two, it's rallying, but it's doubted, it's hated. They say, no, it's a bear market. It's going to go back down again. It keeps rallying, climbs the wall of worry. Gary Gensler's trying to take out Bitcoin. He's denying applications for Grayscale to convert into ETFs. It climbs the wall of worry. Then you enter phase three. Now it's gathered momentum. Now you have a new set of followers. These are paper-handed followers, though, but they're still new followers. So you get RIAs, you get ETFs launching, you get people talking around the Thanksgiving table. It starts getting crowded now. Then now the original buyers, they start selling here because they look around the table and they say, wait, my grandma's buying Bitcoin now. She doesn't understand any of this stuff. What am I doing here? I don't want to be in this boat. They start selling. Then phase four happens. And then you get the dip that keeps dipping. People look at the fear and greed index and it says fear, fear, fear. When I bought before, I made money, but most likely the new buyers looking at that, and they weren't buying before because they weren't in it before. So they start buying it. Then they start buying on leverage. They'll make their money back on the bounce and they'll delever then. And then they blow up, so they lag. In fact, we're actually seeing this happen now. There's a Hong Kong fund that was levering it, purchase of Ethereum on the way down from 4,000, 2,000. They've had to delever and liquidate, and when that asset price bounces, they have to delever some more because their LPs are going to demand their capital back. And isn't this the pattern for markets and cycles? And isn't that at risk of playing out now across a variety of themes?
Yep. Indeed it is. It is so interesting that Bitcoin a year ago, April, May, it was one of the best bull cases of all time. And right now it's very difficult to see any bull case at all for Bitcoin.
Yes. So, the best time to sell Bitcoin was December 17th, 2024. The markets pulled forward and discounted a tremendous rally in this short period of time. You had this euphoria. We think back to John Templeton, bull markets ending euphoria. It's exactly what happened.
Yep.
And then you had a significant correction, then another rally to 125K. Stablecoin Act passes. That's a top. Everyone's in. Everyone sees into the distance. Everyone's singing Kumbaya.
It's not the beginning. It may be the beginning of something, but it's not the beginning of the bull market.
That's right. So now I think we're in this trough. We're going through disillusionment phase. I don't think we're done yet, though. I don't
think so. It feels like it's
the KOLs have to be scapegoated in some way. They have to be purged from the group. Yeah.
In the last decline, when Bitcoin got down to 15.8, I thought that it was going to. I didn't think it would go down until Micah Saylor's scalp had been collected, and he had said 21,000 is where he would have to start having problems. And I don't know. I never did the postmortem on that. Maybe you know, but he must have done something that gave him some more maneuverability, as he claims he can do if it continues to go down from here. But I was, he survived. But you're absolutely right. He's a pivotal figure.
We need to find the scalps. Yes, I agree. I think the market will want that. You need to see bodies float to the surface. You need to see deleveraging events. Some of that's happening behind the scenes. You're going to see a lot of VC funds unable to raise from their LPs. You're going to see crypto executives leave the industry. You saw Kal Samani leave Multicoin. I don't know why he left. As I understand it, they had a great performance. All to say is you're going to see more observations like that happen. And when it's hated and non-consensus, everyone says, I can't believe you own this thing, then we'll be buying. That's when I want to own it. And we'll be back again talking about Bitcoin and they'll look at us funny. And,
that's right.
That's what we'll be doing.
Well, Ram, this has been really great conversation. I'm so glad to see you again.
Likewise, always a pleasure, Bob. We'll have you on our show too soon. I'm looking forward to that as well.
Awesome. Yeah. We'll, and I've got, and we still have some topics that I wanted to go into, like healthcare and education. We'll save that for a different time.
Awesome. Looking forward to it. Be well
Take care,
now,
Ram.
Bob. Make it a great day. Take care.
I believe the next generation can live better than any before it, but only if we stay curious, keep learning, and refuse to accept decline as inevitable. If that message resonates with you, please hit subscribe and share this video with someone who's curious as well. And if you'd like to go deeper, you'll find essays and research on my Substack. The link is below. Until next time, keep exploring.